if the value of every dollar is less, why is it so strong? Well, this is not necessarily tied to purchasing power in the United States. When you talk about the strength of the dollar, you're talking about the strength of the dollar as compared to a basket of other currencies, including the pound, the euro, the yen, I mean, everything. There's a basket of currencies, but I'm just going to go ahead and generalize and say international currencies or other currencies, okay? It's the value of it compared to others, your purchasing power as compared to other currencies. How does this matter? Conversion rates, right? So for example, if one US dollar used to equal, 0.75 pounds, what does that mean? That means if I were to go over to England and I converted my money and I had $100 and I converted it, it would be worth 75 pounds. And if things cost the same relative, you're losing money because this is much stronger. That's what you're doing. You're getting less for your money because it's not worth as much. So when we're talking about the value of the dollar, we're talking about it in comparison to other currencies, not necessarily into the purchasing power in your own country, right? In that case, that's where inflation affects you, right? Inflation at 8% overall, that means the average purchase of something you do is 8% higher, okay? Even though the dollar is still only worth $1. But in comparison to other countries, it's worth more. Why does that matter? Because then that becomes what we like to call a hedge, right? Or a safe haven for investing right now. Why would you invest in something that's going down in value compared to the dollar? You go with the dollar. Also to keep in mind is that the dollar is tied to almost all international purchases when it comes to bulk items like oil, right? We still have oil currently at the petrodollar, right? So when you trade oil on the global market, you have to trade it based on the dollar. All right, which gives more underlying value to the dollar. Also, the credit rating in the United States is higher, so therefore the currency is higher, okay, is worth more compared to others. So you might be saying to yourself, but Stocky, I get that, but why is it going up compared to others? There's several factors, not just the fact that the dollar is tied to so many currencies, so much international bonds are held in it, so much, for as far as, belief in that the payback is with that. But more importantly, remember the printing that happened? All that printing that we did that helped drive some of this inflation? Well, what we do is we take the amount of money printed in terms as it relates to GDP. So let's say the US's GDP is $20 trillion and you print 10 trillion, okay? You have now printed 50% of your GDP into debt. That's a lot. But if you're a country like, let's say, England, because that's in that currency exchange, and your GDP is 2.5 trillion, guys, I'm just making these numbers up, just chill. But if they print 2 trillion, yeah, they printed 8 trillion less, but as a total of their GDP, significantly higher, okay? Which then, compared to what the US did, drives down the value of their currency. So although they printed less money, in terms of how much they printed to their GDP, they put themselves in way more debt. That's an 80% as compared to 50%. So what happens is now your money compared to somebody else, especially somebody on the global scale whose currency is traded so much, your debt to GDP ratio is significantly higher. Therefore, your currency compared to somebody else who did less drops. Now, I know, like I said, this is a generalized thing. I know a lot of people are going to come out of the woodworks and say, well, there's so many other factors. There absolutely is. But people are flocking to the dollar, even though inflation is going crazy, because inflation is affecting us as well as everybody else. But compared to other global currencies, especially the ones that are tied directly to, the DXY, ours isn't looking so bad. It's not great, but it's not as bad. It's kind of like closing time at the bar and a girl walks up to you and says, hey, you want to get out of here? You're like, why the fuck me? And you look around and you're like, oh, that's why. You ain't great. You ain't good, but you ain't as bad. You ain't the worst. Okay? So you got lucky. So in this case, same thing with currencies, okay? What does this lead into why cash matters right now? So you're going to see a lot of companies on their earnings report and a lot of people talking about cash on hand. What is cash on hand? How much liquidity you have. If something happens, can you weather through it? Or do you have to continue to raise capital? Okay, now why is this big? Well, over the past 2 years, nobody needed to keep cash on hand. You didn't need to. Matter of fact, if you had cash on hand, it probably was bad for your company. Why? Because you should be putting that money to work. You can get, 0% interest rates. You can take large amounts of money out from loans at almost nothing to pay back as far as interest rates. You had the PPP, which gave a lot of businesses a lot of money. And it was easy to raise funds. You could do a stock offering. You could do a private equity raise. You could do a revolving credit door. You could do a million different things. So nobody had cash on hand. And that was great for a while. Businesses expanded. They were using all that cash. And they were hiring people. And they were expanding and they were acquiring other businesses. They had very low cash on hand. But now we're moving into a time where rates are going up, so it's not as easy to get as much cash. Liquidity is falling out of the sky in a lot of places, so it's not as easy to raise money. And if we do get into a recession or stagflation, it's going to be almost impossible to raise cash without having to completely dilute your company. And that's why I said, if you look at the Russell, right, which is your small to mid cap index, there's going to be a lot of companies that are there now that aren't going to be there in a year or two. I'm sorry, it's just going to happen. It's like 2001. A lot of those businesses that dot-com bubble that became, multi-billion-dollar market cap companies disappeared. Now, they could go bankrupt, they could get dissolved, they could get acquired, they could get delisted, but it's going to happen because the fairy tale is kind of ending for some of these. And that's why a lot of people are dumping shit out of the Russell because they don't know which company it's going to be. You're like, Stocky, how come these stocks are down 75, 80%? It doesn't make any sense. People are dumping it. They don't want to be in that right now because they don't want to be in the one that does go dissolved or gets delisted or gets trashed. Yeah, Amazon, Apple, Microsoft, they're all going down because, liquidity issues and concerns of inflation and price problems and stuff like that. So yeah, the market's pricing that in, but your Russell, your mid cap and your spec stocks, they're crashing because nobody wants to be in the one that gets gone. However, that is going to lead to a lot of extremely undervalued companies that are going to survive this. And when it's the dust settles, people are going to dump their money back into the ones that they're like, okay, this is down 90% and it survived. Let's fucking go. Right? So cash on hand. This is part of the reason I'm actually a little concerned for Disney right now. Now, I know Disney wouldn't have a hard time raising capital, but Disney doesn't have a lot of cash on hand right now because they've been acquiring so much and they've been expanding and they've been investing, which is great in a bull market. But when you go flat or you go recession and you don't have a lot of cash on hand, then you have to start cutting projects, taking L's, cutting people. And we're seeing it. We're seeing it across the board. All these corporations are cutting people. All that free money, all that money they had, all that non-cash on hand that they were putting to work is gone, and they're cutting payroll. Carvana's the latest. Robinhood, Zoom, all of them. There's going to be a massive wave of layoffs coming. It's not over yet, okay? So cash on hand is big. You need to have the liquidity to get you through the hard times because you have investors. You have people that are that you owe money to. And they're going to want their money back eventually. And you're going to have to give it back to them. And it's either going to be by borrowing from Peter to pay Paul, or robbing Peter to pay Paul, or going insolvent and declaring bankruptcy. So when I see these companies that are doing offerings right now and they're actually getting filled up, or they're doing capital raises and it's like, okay, they're not giving up too much for the cash right now, I'm like, okay, I'm going to keep that on my watch list. Because if we do, and I'm not saying we are, but if we do go into that flat, bearish, crap time, stagflation, recession, it's going to take a lot of cash on hand to burn through just to keep you alive during that time. That is why when I see, I'm seeing some of these businesses start to hoard a little bit more cash. Now, you don't want to hoard all your cash because then you're not expanding, you're not hiring, you're not doing anything, right? That's a bad sign. But if I start seeing businesses and I see their earnings call and they're like, oh, we're up this much cash on hand, or we've got this much cash on hand, or we're doing this, or we're doing that, and they're making the moves now, that lets me think to myself, okay, they may be one that can survive. Doesn't mean that they're going to not go down, but it means they can survive. Because in this case, you want to be into companies that not only do you think are going to be good long-term, but that can survive. Because even if it's a great company with a great idea and a great vision, if they don't make smart financial decisions, they could dissolve and you lose your money. You want to be able to get in a company that can go down to here and hold before going up. Because if it doesn't, it's gone. How does this affect your job? Well, it depends. Were you hired in the last 2 years? Are you in a business that was booming due to COVID that's now going away? Are you in a business that is, are you in a non-essential job? I mean, there's so many things there. Disney's not going to dissolve. No. I'm talking about how much pain is going to happen with Disney before it gets better. Because like I said, I'm not the CEO. I don't know the ins and outs. They may be putting that money to work in a way that they think is going to help them even better through COVID or through a recession. But I'm just saying that I that was a little bit of a red flag for me. I didn't sell any positions. I mean, I added Disney today, but I'm something I'm keeping an eye on. The only thing holding us up right now, in my opinion, is the housing bubble, which I hate to say that. Imagine being held up on a bubble. Rates are going up. Let me give you guys it's a generalization, but it kind of falls in line. For every 1% increase in the federal funds rate, you expect a 10% decrease in housing prices, generally speaking. So if they're going for 3% by next year, you would normally price in 30% down on the housing market. But that may not happen. And one of the reasons that may not happen, rent prices. And that is a whiteboard for next time. Dun, dun, dun. Oh, people not having cash on hand is absolutely a thing right now. And I'll tell you why. The amount of money we went from savings to credit has completely inverted to the same levels it was pre-COVID. Think about that for a second. It's not fun looking at stocks now. Oh, I love it. I just keep watching it, playing it daily, and looking for things I think that are on sale that may not be the bottom, but I'm like, oh, I'm going to get a little bit of that. Oh, I'm going to get a little bit of that. Think of the stock market right now of being at a buffet, right? A massive buffet, and you're hungry. And you came in last week and it was all good, but now pickings are slim and some of that food wasn't changed out. So some of it's rotten. And you're thinking to yourself, I'm really hungry. This is the only option I have. Actually, that was a terrible example too. I'm really bad at analogies today. Because when you look at the stock market, remember the market, at least in theory, is all about pricing in the future. At least that's in theory what it's supposed to be. It's not. It's a casino that just we use instead of playing instead of playing poker because it makes us look like we're more, intellectual or more, hoity-toity or whatever. But something to keep in mind is that when you see the markets go down and you see this, you're supposed to be thinking to yourself, okay, so we're expecting how much value loss in what amount of time? And so with that, you're thinking to yourself, okay, we're now pricing in GDP reversal, higher than normal inflation, potential stagflation, maybe a recession, how long the Ukrainian crisis is going to last, China lockdowns. You're doing that. And so you start saying to yourself, okay, what changes to make us think that things are going to get better and then you can look at your treasuries right now to see where people are thinking how long it's going to take for it to get better and get back to normalcy. And so if a new development happens and it's not a positive, we keep falling. If nothing positive happens, there's no reason to be buying right now. So that's what everybody waits for, is a sign that things will be better in 5 years or better than expected. We're pricing in the next 5 years. So let's say China says, you know what, screw this COVID thing. Let's just get back up and running. Boom, market goes. Russia says, you know what, we screwed up. Let's move off. Boom, it goes. Fed comes out and says, hey, we're going to raise rates at 50 basis points, but we're basing it off of the GDP report that GDP actually grew last quarter and inflation's down 2%. Boom, we're going, right? But until then, at the macro level, there's nothing right now that is giving everybody the confidence that in the next 2 to 5 years, we're going to be back on as we were before the pullback.